Here is something that almost nobody in the financial industry wants you to believe, because their entire livelihood depends on you believing the opposite. You do not need to be brilliant to build wealth in the market. You do not need to study charts for hours. You do not need to predict the next great company or time the next crash or outthink the professionals who do this for a living. In fact, Benjamin Graham proved something that sounds almost absurd when you first hear it. The investor who does less, who keeps things simple, who refuses to be clever, will very often beat the experts who spend their entire careers trying to be brilliant. The lazy strategy wins, and by the end of this video, you are going to understand exactly why and exactly how to use it so that you never again feel like you are losing a game you were told required genius to win. And I should warn you, once you truly see this, you will never look at a confident financial expert on television the same way again, because you will understand something about their results that they would very much prefer you never learned. Graham divided all investors into two types, and understanding which one you are is the most important decision you will ever make about your money. He called them the defensive investor and the enterprising investor. And the names are slightly misleading, so let me make them clear. The enterprising investor is the active one. This is the person willing to put in serious, ongoing work, studying individual businesses, analyzing financial statements, hunting for bargains the market has overlooked. It is a real path, and it can work, but only for those with the time, the temperament, and the genuine willingness to treat it almost like a second job. The defensive investor is the passive one. This is the person who wants a sound, sensible return without dedicating their life to the markets. And here's the part that shocks people. Graham did not think the defensive approach was the inferior one, the consolation prize for those who could not handle the real thing. He thought it was the right choice for the overwhelming majority of people, including many who imagine themselves capable of more. So hold one question in the back of your mind as we go, because by the end of this video, you are going to have to answer it honestly. Which of these two investors are you really? Not the one you would like to be, the one your actual life will allow you to be. The answer matters more than almost any stock you will ever pick. Now I want you to sit with the most counterintuitive idea Graham ever taught, because it overturns almost everything the financial world tells you. We are conditioned to believe that reward comes from risk. Take bigger risks, the story goes, and you earn bigger returns. Graham looked at this belief and called it a dangerous confusion. He said that the return you deserve from investing is not determined by how much risk you are willing to take. It is determined by how much intelligent effort you are willing and able to bring to the task. Read that again, because it changes everything. Your returns do not come from courage. They do not come from boldness or from stomaching wild swings or from betting big. They come from the quality and the quantity of intelligent work you put in. And here is the beautiful consequence of that idea. The defensive investor who chooses to put in very little effort can still earn a perfectly good return precisely because they are honest about how little effort they are putting in, and they choose a strategy that does not require any more. This is where the lazy strategy reveals its genius. The defensive investor does not try to beat the market. They do not try to pick the winners. They do not try to dodge the losers. They simply own a broad slice of the entire market through a few simple low-cost holdings. And then they do the hardest thing of all, which is almost nothing. They let it sit. They let it compound. They resist the constant temptation to tinker, to chase, to react. And the staggering truth, proven again and again across decades of data, is that this almost embarrassingly simple approach outperforms the vast majority of professional money managers. Most of the experts, the highly paid, deeply credentialed professionals whose entire job is to beat the market, fail to do so over the long run. They fail after their fees are counted. They fail after their mistakes are tallied. And the quiet, disciplined defensive investor who did almost nothing ends up ahead of nearly all of them. It is one of the most well-documented and least believed facts in all of finance. Let me put some weight behind that claim, because Graham believed a principle without evidence is just an opinion. Study after study, conducted over many decades, has found the same uncomfortable result. The large majority of professional actively managed funds fail to beat a simple index of the whole market over long periods. Across 15 and 20-year stretches, the proportion of professionals who fall behind the simple approach climbs to the overwhelming majority. Think carefully about what that means. These are not amateurs. These are people with the finest educations, the most powerful computers, teams of analysts, and access to information you and I will never see. They wake up every morning and dedicate their entire working lives to one task, beating the market. And most of them lose to a strategy so simple a child could follow it. If the brilliant professionals with every possible advantage cannot reliably beat the lazy approach, what exactly makes the average person believe that they can? Graham's answer was blunt: they cannot. And the moment you accept that, you stop trying to win a game that almost no one wins, and you start playing the one game that ordinary people actually can. Why does this happen? Why does doing less beat doing more? The answer cuts to the heart of human nature. The professionals are not stupid. Many of them are genuinely brilliant, but they are trapped in a system that forces them to be active, to constantly buy and sell, to justify their fees with motion, to react to every headline and every quarter. And all of that activity is precisely what destroys returns. Every trade carries a cost. Every clever move is a chance to be wrong. Every attempt to time the market is an invitation to miss the best days, which, as we have discussed before, tend to arrive right after the worst ones. The defensive investor sidesteps all of it. By refusing to be active, they avoid the very mistakes that activity creates. Their laziness is not a weakness, it is a discipline. It is the discipline to do nothing when doing nothing is the wisest possible move, which in investing is far more often than anyone wants to admit. Graham gave the defensive investor a simple structure, and its elegance is the whole point. He suggested dividing your money between two things: stocks, which are ownership in productive businesses and provide growth, and bonds, which are safer and provide stability. And then he offered a guiding principle that protected investors from their own worst instincts. He said you should never have less than a quarter, nor more than 3/4 of your money in stocks, with the rest in bonds. The simple starting point was an even split, half and half. Now, the exact proportions matter less than the wisdom behind the rule. What Graham was really doing was building a fence around your emotions. When the market is soaring and greed tempts you to pour everything into stocks, the rule holds you back, capping you at 3/4 so you can never be fully exposed when the inevitable fall comes. And when the market is crashing and fear tempts you to flee into the safety of bonds, the rule again holds you back, keeping at least 1/4 of your money in stocks so you are never completely out when the recovery arrives. The structure does not just organize your money, it saves you from yourself. Let me show you how quietly powerful this is with a simple picture. Imagine two people who both start with the same modest amount and add to it steadily over 30 years. The first is constantly active. They chase the hot stocks. They jump in and out trying to avoid every downturn. They pay fees on every trade and taxes on every gain. And they switch strategies every time the last one stops feeling exciting. The second person does almost nothing. They own a broad, low-cost slice of the entire market. They hold the sensible split between stocks and bonds, and they simply keep adding to it and waiting through every panic and every boom, never flinching, never tinkering. After 30 years, in the great majority of cases, it is not even close. The second person, the one who did almost nothing, ends up far ahead. The first person's constant activity did not protect them. It quietly drained them a little at a time through costs and taxes and mistimed moves until the gap between the two became enormous. Consider just the leak. If all that frantic activity cost the active investor only 2% a year in fees, in taxes, in trades that went wrong, that small sounding number compounded across 30 years can quietly consume something close to half of everything they might otherwise have had. Half their fortune gone, not to a crash, not to bad luck, but to the simple act of trying too hard. The lazy investor did not win because they were smarter. They won because they gave the compounding machine the one thing it needs above all else, which is to be left alone. And this brings us to the real secret hidden inside the lazy strategy, the thing that makes it work when so many clever strategies fail. The defensive approach succeeds not because it is mathematically superior, but because it is humanly survivable. The greatest enemy of investment returns is not a lack of intelligence. It is a lack of emotional endurance. Brilliant people destroy their wealth all the time, not because they cannot understand the market, but because they cannot sit still inside it. They panic and sell at the bottom. They get greedy and buy at the top. They abandon a good plan the moment it stops feeling exciting. The defensive strategy is built to be so simple, so boring, and so automatic that it removes the opportunities for emotional self-sabotage. There is nothing to tinker with. There is no clever move to second guess. There is just the steady, patient ownership of productive assets held through every storm. And a mediocre strategy that you can actually stick with for 30 years will demolish a brilliant strategy that you abandon after 3. This is worth dwelling on because it is the reason so many intelligent people end up poorer than their less clever neighbors. A strategy only works if you can survive every moment of it, including the moments that feel unbearable. The cleverest plan in the world is worthless if it asks more of your nerves than you have to give. And the active enterprising approach asks a great deal. It asks you to watch your holdings swing violently and do nothing. It asks you to be right repeatedly in a game where even the professionals are wrong most of the time. It asks you to stay disciplined through years of boredom and moments of genuine terror. Most people simply cannot do it, not because they lack the intelligence, but because they lack the iron stomach the active path demands. The defensive strategy was Graham's answer to this very human weakness. He designed it to require almost nothing of your nerves because he understood that the strategy you can actually live with will always beat the one that looks better on paper but breaks you in practice. The best investment plan is not the one with the highest theoretical return. It is the one you will still be following when you are old. Let me be very fair here because Graham was always fair, and he never pretended the defensive path was the only honorable one. The enterprising investor, the active one, can absolutely earn higher returns. But Graham attached a warning to that path that almost everyone ignores. The enterprising approach only rewards those who bring genuine, sustained, intelligent effort, real analysis, real discipline, real work, done consistently over years. The disaster happens when people want the enterprising investor's higher returns while only putting in the defensive investor's level of effort. They want the reward of the active path without the work of the active path. So they dabble. They pick a few stocks based on a headline. They trade occasionally on a hunch. They put in a little effort and expect a lot of return. And Graham understood that this half-hearted middle ground is the single worst place an investor can stand. It carries all the risk of the active approach with none of the genuine work that makes the risk worthwhile. The dabbler loses to the disciplined enterprising investor and loses to the disciplined defensive investor at the same time. The only people who lose are the ones standing in between. So the honest question you must ask yourself is not which path produces higher returns in theory. It is which path you will actually be able to walk in reality. Are you truly willing to treat investing like a serious, ongoing job, studying businesses, reading reports, doing real analysis year after year through boredom and through fear? If you are, the enterprising path is open to you, and Graham would respect that choice. But if you are honest with yourself and the answer is no, if you have a life, a career, a family, other things you care about, then the defensive path is not a compromise. It is the intelligent, mature, and frankly superior choice for you because it is the one you can actually sustain. There is no shame in it. There is only wisdom. The investor who knows their own limits and builds a strategy around them will always beat the one who overestimates themselves and collapses under the weight of a plan they were never able to follow. Graham understood all of this, not as abstract theory, but as hard-won experience. He had watched the market punish overconfidence again and again. He had seen brilliant, ambitious people convince themselves they could outsmart everyone. And he had watched the market humble nearly all of them. The defensive strategy was his gift to the ordinary person, his way of saying that you do not need to enter the arena and fight the professionals to win. You can simply step outside the fight entirely, own a piece of the whole productive economy, hold it patiently, and let time and compounding do the work that frantic activity never could. It was a profoundly democratic idea. Wealth building, Graham insisted, was not reserved for the geniuses or the insiders. It was available to anyone disciplined enough to keep things simple and patient enough to wait. So let me give you the practical heart of all this, the thing to actually take away. First, answer the question I asked you at the beginning, the honest one, the uncomfortable one. Which investor are you, really? Be brutal about it. Not the one you wish you were, but the one your actual life allows you to be. For most people, including most people who would never admit it, that honest answer is the defensive investor. Second, embrace the simplicity rather than resisting it. The urge to do more, to be clever, to add complexity is the very urge that destroys returns. Owning a broad, low-cost slice of the market and holding it is not a beginner strategy you will outgrow. It is the strategy that beats most of the experts, and you can use it for life. Third, build the fence, Graham described. A sensible split between growth and stability, and let that structure protect you from your own emotions when greed and fear come knocking, as they always will. And fourth, understand that the hardest part of this strategy is not the knowledge, it is the discipline to do nothing when every instinct is screaming at you to act. Because that is the final paradox Graham wanted you to understand in a world that constantly tells you that winning requires more effort, more cleverness, more action. The market quietly rewards the opposite. It rewards restraint, it rewards patience, it rewards the humble investor who admits they cannot predict the future and simply owns the productive world and waits. The experts will keep trading, keep predicting, keep straining to be brilliant, and most of them will keep falling behind. And you, doing far less, worrying far less, and sleeping far better, can quietly end up ahead of nearly all of them. That is not a trick. It is not luck. It is the deepest wisdom in all of investing. And Graham handed it to ordinary people more than half a century ago. The only question that remains is whether you are humble enough and patient enough to actually use it. Because the lazy strategy only beats the experts for the people who are disciplined enough to be truly, deliberately, intelligently lazy.